Welcome, it's the Market Sniper. In this video, we're going to update you on why debt markets are about to become a major problem again. And this is looking like a setup that's going to roll into probably August, September, October period. I'm deeply concerned. Many people have left quite angry comments about how I've referred to a demand-destroying event before, and as yet, in their view, nothing of that nature has taken place. This coming Q3 into October can lean into October, November, Q4. In other words, August, September, October was my targeted time frame for the demand destroying event, running into with repercussions and fallout into the year end. And you only have to look at the United Kingdom doing a Pegasus pandemic drill. You only have to look at the CBDC launches that are going on in Europe, planned for October, and similar timeframes to know that there's a lot of event risk and drills that appear to be occurring. In the meantime, the setup could indeed be the financial debt-based system and the movements that the markets are making towards exiting as reserve assets debt to a larger degree. So this is the US 10-year. In this video, by the way, before I go into the deep dive on the technicals, in this video, I intend to give you an update on why debt is about to devalue again, what the trades are, in other words, some of what we'll be doing in the community, so some free trade ideas that are non-advisory. It's entertainment. It's for us. We're not regulated. It is how I intend to position for the economic events. So call it a financial journal, if you will, and give you some idea of what we discuss also on a non-advisory basis in our community in terms of trades that we prepared to take. All of that, and then we're going to have a look at other people's opinions on the debt markets, a couple of videos, and a short rehash of what happened for Liz Truss and Kwasi Kwarteng, with some information you probably don't know about the Bank of England pension funds as the sucker money that is the buyer of last resort, and how they created a special multiple leverage product for the pension funds when they were not getting sufficient return, and how that all turns out, and why, if it applied to the United Kingdom, it's quite likely to apply in other countries, Western countries particularly, which has a gilt/bond pension system whereby the returns continue to drop in terms of yields during the 40-year bull market, and later how they leveraged up probably to meet their requirements to their existing pensioners, and why that ends in a pension bust as well, with many elderly people not able to fund their retirement despite making contributions the whole of their life. Okay, let's get into that. First of all, let's do the charts. US 10-year, what's going on here? So because we have been in a much longer, broader continuation pattern, that means we have traded inside of a range that was up here. By the way, we called for that target. That target was run. It came out of the W bottom here. Let's get our favorite TG Pink and fatten it up a bit. That W bottom target generated there, called the high in essence for that bond market up top. Let's just get you a number for it, just so that we're referencing it as near as damn it possible at the 5% mark. We had a blue line at the 5% mark. I think I lost it. I probably dragged it away by accident. Should be up there. 5, there we go, 5%. Then we had a down leg, a bit of a rally, and a further down leg. And this was like, that's it, when cutting, you know, all this big cycle. We spent a whole bull market in yields and a bear market in debt, with everybody asking when cut. The economy is not great broadly. And I've made a lot of that before, the consumer in terms of the economy. There's a lot of nominal highs based on a much higher inflation rate than people realize, that are actually deflating in real terms, such as your stock markets. But we think stock markets is a bit like watching the under nines when you have the World Cup final playing behind you. The key thing is the foundation, do draw pyramid with hands, is the debt currency system, and that is unraveling. It's incredibly liquid to trade in currencies. We've been incredibly well served with the Swiss franc on the long side, which has been crowded into as a reserve asset, and the Japanese yen to the downside. And you can get away with very big size, very tight spreads. And FX is typically, for many, a hard market to win. But in these debt-based, and this is a debt-based collapse system, there are real opportunities here that are absolutely going to give you a golden moment in currency markets. Keep on keeping on. They're going to be lengthy trends. And, of course, as the reserve asset collapses, gold, precious metals, and we still maintain that Bitcoin will be good for a 150K run as well. So the anti-fiats will be doing exceedingly well. Now, as I mentioned, rates climbed very, very sharply for a while and had done a lot. It's invariable that there's a consolidation. So I'm being sent clips about how the top is in for rates. Money's going to be rushing into the debt markets. Rates are coming down. The economy's weak. Central bankers, will cut rates. As I've said before, central bankers do not control the rates in extreme times. If the market won't accept the valuation of debt going up, they do not get to cut rates. That's why you've got this friction with Trump and Powell. Because Trump wants cuts, he wants easy money, but he wants to spend like a drunken sailor. And Powell has got a bond market to answer to that won't allow it. And what's happening in that bond market for all those guys that are calling cuts? This is what's currently going on in this bond market. And we are now getting to the point where there starts to be real opportunities for getting close to the end of a potential setup for a breakout. And you saw how it moved when it broke out. You saw the price behavior of the interest rates coming into this. And we have been consolidating for a lengthy period. I repeat again, there are a lot of people misinforming people telling me they're putting clients into bonds. This is the top of the bond market. This is what they're going to do. Central banks still control rates. They do not at the extreme levels. Their market will tell them they will not be buyers. They know there's tepid sponsorship. In fact, it's not just US debt that we're talking about. We've got the US 10-year up here. I'm going to show you the UK and the Japanese debt. And I'm going to remind you that nobody was doing Japanese debt-based upside projections on the long end of Japanese debt 2 years ago, 18 months ago, 9 months ago. And it suddenly became, oh, look here, this number's getting bigger, all on the long end particularly, but also across the board. And there's two stories in here. The long end is stretching out on yields even faster than the short end, and central banks are probably losing control to a degree of the long end. The other story that we're going to be making is that just because the rates going up doesn't mean always that your currency will spike, something milkshakers are absolutely convinced of. And it won't necessarily mean that. You've already had the tariff tantrum with Trump, where, and I've shown this in previous videos, the rates went up and the currency went down. You're busy witnessing it on the Bank of Japan, where the long end is running at its fastest rate up and the currency is going down. And you're also witnessing it, or you witnessed it, in the United Kingdom during the Truss Kwarteng issue, where rates spiked, the debt went down strongly, and we're going to be doing a little bit more on that in a minute, and the currency collapses. So flight capital, foreign investor capital, and even high net worths in their own country will sell the debt, will sell the currency, and charge it off somewhere else, like gold, like the Swiss franc, and other long-term, let's say, reserve assets if we're talking precious metals, or transactional currency that is not devaluing at the same rate as the dollar, such as the Swiss franc. Anyway, this is the first upside draw of a substantial time frame. I'm on a 2-day chart, and it's quite compressed. That indicates the possibility that if you break this level, remember, this is speculation, it is forward looking. I've got other bleaters that are saying your gold silver ratio hasn't gone through 170, you've lost all credibility, etc., etc., etc. No, the demand destroying event hasn't occurred. We haven't had a sell of everything. It hasn't happened. And we said it's a possibility that people are not taking seriously enough. We didn't say it's guaranteed to happen. Just like I can't guarantee you that will cross that line and trigger this pattern. And I can't guarantee you that once triggering it, it will guaranteed make the target, but it has a propensity to do it. This is speculation on balance of probabilities. Everything we say is is a probability game. We think the probability is higher that you will run that level of 4.62, and having done that, you will have a higher than is priced into the market currently run to 6.14 8, which means you'll be looking at 6.15 on a 10-year, which is not even the strong long end of the US market. So let's be clear, that is going to be fatal for commercial property which has borrowings on it. By the way, properties that sold for 200 million are selling for 3 million today in Denver. That was $3 per square foot. $3. I can't remember if it was per square foot or per square meter. That actually makes quite a difference. I'm going from memory from an ex-tweet. But whichever, it is shocking to lose 197 million on a purchase. Imagine, pension funds are commercial property holders. Pension funds are also debt holders. One of the biggest collateralized fallouts of this is going to be in the pension industry. And I'm going to be referring to that with the Liz Truss small segment I'm going to include on all of this. So here you go. This is the 10-year. It looks like it's going to break out for me. We've got our alerts. We await it. What's the trade? That will be a TLT short. TLT is long-term. It's 20 plus, funnily enough, not just 10. It's not got 10-year in it, but I'll be showing you the US 20-year. Let's not look in crypto for that, shall we? Just so that you can also see, it's easier on the longer we go duration, the more it's quite clear we're close to highs. You see this curve is now quite a bit higher up than the other one, that over there. And by the time we pivot to a 30-year on the US debt, you will see you're already very, very close to highs, and you have already been leaking out the top on the long end. Look at that. Look at that on the 30-year now. You are virtually, so on the 10-year, this was 5%, remember? You are virtually within a few percent of the all-time high. This is showing how the long end of the debt market is climbing a lot further up and has got a natural bleed out to the high side, and that we are in a debt-based collapse. Get it into your head. Get it into these other guys' head that are sending me things. No, we've topped on the bond market. It's all the way down. Treasuries are going to be a great investment. Da 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 da. All this nonsense that I'm getting. The central banks do not have the power to print if no one will buy. They have to create so much fear in other assets that money exits stocks, exits everything else. And for that, I think you've got maybe your August, September, October period to hope for that. But even still, you will not get the pump and the bump in treasuries as much as you think. And more of the money will, after a short dip, run back into gold once the crisis, the short-term liquidity is done. This is very, very close on your 10-year to all-time highs. And you're going to see a lot of what I consider as hyper-normalization of this fact that this is a debt-based collapse. You're 2.85% off making a new high on the 30-year debt. So you can see it's also the long end, because if I go back to the 10-year, you're not that you're getting there, but you're not yet ready to make a new high on the 10-year. You can see how that's more squared down. But this is going to go into a breakout, and it's going to start to see the shorter end of the long end, if that makes sense, 10 years, also starting. You're looking at 10.48% down from the, when I say all-time high, post-COVID collapse all-time high. Obviously, we had higher rates in decades before. So you can see how that's is turning out. So the US debt market, and what happened after the first fall in debt. So let's have a look at the valuations. TLT is the best. It's a long term. We called that short up top there. We expected a bounce here for a shoulder. It was a bit of a bigger shoulder than we thought. We have to admit that. And we thought maybe we're going to be proven wrong here. And then it came back and broke all the way down, ran our target, and then it's been grind mode. This is getting close to a new all-time low because it's stuffed with the long end. It's 20 plus. It's 20s and 30s debt. It's an ETF of 20-year duration. The long end is being lost. This is a short. That would be the trade again to trade. If the 10-year starts breaking out and running, it's going to have real knock-on effects also on the 20 and 30. Remember, they've got an extra 10 or 20 years of compounding an inflation rate, which is the currency debasement. What people need to realize, when you have a currency USD and a treasury instrument, that's the two parts that borrowed money into existence. Someone has to buy the asset, that's the treasury, and then the money is issued to a government to spend or to a homeowner to buy a property, whatever the case may be. Now, the homeowner buying a property, at least there's some collateral against there. When governments spend, it's they have the right to spend on the basis that they have citizens that pay tax and that there will be an income stream associated with that. Well, if they're destroying their citizens' pensions, they've taken out the top end of the age band, they're crushing the economy. Actually, the tax flows that they're going to get are far, far less. Plus, they're going to get a negative, there's going to be a disinflationary as the money and the debt is being written off. There's going to be a shrinkage in money. That's the demand destroying event where even the risk on assets get a pullback. Gold will pull back, everything will pull back because everybody will have to dash for cash because money is being destroyed. So initially you're having inflation and then you get this chronic money is being killed, disinflation, everybody scrambles. And that's why I say have some cash. It's not a growth instrument. It's about being able to survive for a period that could be longer than you think when you have a debt-based collapse. So with that understood, this is going to go lower, TLT lower. You go lower. Can it go lower? Yes, it can. It's going to go lower than it was in 2000, right back down in there in 2004, in our opinion. And it's going to continue to go lower until this chart rebases. This is a shrinking asset class. And I'm going to show you people that have got an alternative opinion. And you've got to decide, who's got this right, who's got this accurate. So, but before we leave and go and have a look at George and Jeffrey Snider's take, I want to show you something else. Let's go JP 20-year. This is the Japanese debt. It's at all-time highs, friends, and it's grinding higher. So for those of you that think, so what, that's Japan. No, Japan is just the first to fall in debt as a category. Failure as one of the highest. This is coming to all of them, by the way, for friends of HVF. Beautiful 3 with an M head, 2 there, nice funneling, and third impulse here inside the rising wedge. It's going to be a break to the upside. Now you'll get so many people that are new to technical analysis and say rising wedge equals down. And generally that is accurate. That's the general rule. However, in an incredibly weak market, the continuation patterns are not horizontalized. Everybody is distributing debt all the time. So here it's devaluing and rates are climbing. Here it's meant to be resting, and that's meant to be a squared up continuation pattern. But there's not much buying. There's not much buying of the rates or selling of the rates, which means buying of the debt across the top. So in actual fact, what tends to happen is the people that are just selling out continue to sell out. It's an open secret, and there's none of this here. So what tends to happen is you make a structure like that, the rising wedge, and you get 3 impulse a la the HVF method. And you can learn about how we do all of this, and you can watch us implement it. This is going to break out to the upside, and it's going to confuse all the traditional technical analysts that do not know the context of the environment and when the exact corollary applies. And there's going to be a lot of counterintuitive logic given to you today, because some people will say, but Francis, rates going up means gold should go down, Bitcoin should go down, the stock market should go down, all of these things in the bond market going up, which is going to stop the Fed from cutting, by the way, and may even see them need to raise rates first. And of course, everyone's going to say that's going to kill your gold trade. That's going to kill your... In a normal market, yes, just like in a normal market, a rising wedge is more often a breakdown. However, what tends to happen is if the selling of the debt is because it is no longer trusted as a reserve-based asset, that money that is getting out is moving into something that will be considered a reserve-based asset. And that is physical things over pieces of paper. And that is gold, firstly. And the central banks have already shown you that. And it's silver. And it's even copper and other material, physical held things. And it's going to be Bitcoin if you're a buyer of the digital scarcity solution. I think it will go higher myself. I'm not an over-truster of the digital money system. But those things will actually go up on rising rates because the rising rates are rising for a different reason. Not because of a healthy economy, but because of a crushed consumer and a debt-based collapse where no one is a buyer and nobody else new wants to be an investor in debt instruments. In other words, it's a rotational major move out of an entire asset category that is leading to the phenomenon of rising rates, which in of itself is very bullish for the recipient asset classes that will be getting new money from a massive market cap. Something 300 trillion, something 500 trillion, others think quadrillions. Okay? So think about that for a while. That asset category is going to go into a base of collapse. The yen, throughout this period, with the 20-year going up, is actually going down in value. Here, by the way, is the JPX. We've shown lots of our Swiss franc JPY charts, and I continue to give a little update over there every now and then on X. Follow the Market Sniper on X. You can also follow the Crypto Sniper on X. There's great stuff going on there. You see you've got a flag target there. You've formed a perfect flag on our neckline, which has shown that this is a key level. We call that armpit 2 and armpit 1, and that is the foundational jump onto the ledge over there, but it's part of the left shoulder, bit of complexity. Head, right shoulder, flag, target, down here, and we actually expect the head and shoulder target to go down there. More downside for the yen, which actually sees me see more higher rates counterintuitively, because the higher rates is the selling of the money out of Japanese treasuries, which is exiting Japan. Once you've sold the Japanese debt instrument, the Japanese bond, you're selling the yen, and you're probably putting it into gold. You're probably buying physical assets with it. So it is an exit out of the yen at the same time. In other words, people recognize that for every sinking debt market moment, there's going to be a related sinking currency moment. And that's when currencies go down on rising rates, because you are moving out of an entire asset category, and people don't realize that the two are evil twins. They are tied together. Look what happened to the dollar after the 52% crash in the TLT. We told you it won't be all sun and light for Brent Johnson and his dollar milkshake friends. You can actually have your currency go down. So the high there, all the way to where you are today, shows you 52.75% devaluation over the period of the 2nd of March 2020, when we very shortly thereafter called the top in bonds on the first inverted H in a new trend. It's all over the internet. It's the biggest call we've ever made in terms of significance and reset. We've all known that the dollar is going to collapse. Since 1980s, I was talking to the head of Liberty Life, who said that, in the 80s, that it's in the long run it's going to collapse. But the timing thereof and the trading, this was the technical trading point when you reached peak bonds and it was only net down. So we've all been waiting for that moment. We said, there it is, it's in on that break there, which was in and around August, October August, September, my apologies, of 2020. And since then, it's been a net bear short, and we continue to remind people this is a debasement story. This has actually been a lengthy pause now, that people are not ready to see continuation. Keep on keeping on. It is a continuation trend. TLT trades down out of that. If I reframe that chart, maybe it's easier for you to visualize that it can go lower. Sometimes people just look at the square and say, but you're on the floor. No, the floor is 0. Okay. Right down here, you can go to being a couple of cents worth right down there, over here, So please understand this. This is a debt-based collapse. So let's get on to counter opinions that others have had in the form of our friends here. Now, this title and then this notion I think some people can be too clever. You get the macro movements right. I sometimes think this is being too clever. Michael Burry type bet, wanting treasuries as collateral. This is misinformation. George has even gone so far as a couple of times saying there's a shortage of treasuries. I don't know how he got to that, but you can have a shortage of collateral, but that doesn't mean there's a shortage of treasuries. And this whole discussion seems to be missing the key cornerstone that if the rates are going up, the valuation of the treasuries are going down. That means the sellers are more aggressive than the buyers. Let's just harvest on that. Yet this discussion is hinging on everybody wanting treasuries for collateral. That's my understanding so far. Let's see if you understand it any better. Remember, I have an opinion, they have an opinion. It doesn't make them bad or evil people and doesn't make me right. They could be right, and I'm 100% wrong. So let's just hear what they have to say. I want you to hear contra opinion, and you can come to your own conclusions. Just get past the good buddy bit.
And I believe mortgage-backed securities. And what's rather alarming is I think it's the highest level since Q1 of 2008, if this report is correct. And it's very similar to what they did during 2023 when we had the regional banks, a lot of them blow up with Silicon Valley Bank. So my first thought was, wow, okay, maybe they're loading up on collateral because this is what's going to be, or they believe, they're making a bet that things are going to get worse, and therefore they're going to be able to charge a higher price for that collateral and make some profit. But I wanted to get you on to get your thoughts on this and kind of give me your view as to what's going on.
Yeah, I mean, that's
So banks have had reserve asset limits moved so that they can buy more of the poison chalice, which is part of the cooperation of the Ponzi, in my opinion, and they lack a bit of reset, Sniper. That's my take. And on that point, let's just interlude, because Bill makes this point very, very clearly. I make a point before that, and let's watch the short, that it's actually, if you happen to be like to play with a goat and a cigar and with a 9mm in your pants, and you think the divorce crowd are the guys that are ambushing America, this particular tweet was there to debunk that actually it was American-based money selling treasuries during the tariff tantrum, and it was dollars being sold and money going offshore. And this chart shows that very, very clearly. And I'll put it in front of Bill, and he makes another point, which is the point that these guys are coming in. So let's actually just watch this short. Investor from America was American money. That comes as quite a shock to some people. In other words, those 1%ers and those 10%ers are relocating assets somewhere else. If you have a look at this chart with me, Bill, you'll see that US investors buying US, you can see that when negative over here in the orange. That's the fat orange one. And in actual fact, EU investors buying Europe is positive. EU investors buying US, the thinner one, is still marginally positive. Not as much as buying their own, but is still marginally positive. And if you look at US investors buying Europe and finding Europe cheap, it's a far higher dashed line. So what you're actually been seeing is that America is aggressively buying Europe, which has a far cheaper stock market and also has less exposure to the dollar, which could also mean Swiss francs and Swiss equities as well. I don't think they mean the EU. Switzerland is part of Europe in one way and not part of the EU in another way. And it just happens to have the most solid currency. So that's that point. Listen to what Bill says. Americans selling America and buying the cheap European markets.
Francis, on that chart, I think that chart kind of illustrates why they just relaxed regulations on banks, which freed up $5.5 trillion on their balance sheets, because the American banks were not buying treasuries like they had, and this will give them firepower to do it. But I mean, basically.
So listen to that point. They've actually cancelled reserve requirements virtually down to nothingness, so banks can be virtually bankrupt, but can still, with whatever assets they have, can buy treasuries. These guys are desperate to find a bid on a failing debt market where the rates are still climbing in spite of that. So the American banks are agreeing to go down with the ship, hold the toxic asset, are being unleashed to do it on a greater scale. And these two guys are talking about, these guys want to make some money on this amazing collateral. And when everybody's looking for collateral, they're going to be the guys that have it all. I mean, it's a parallel universe discussion for me. You listen to what Bill's telling you, and he's saying the banks have been unleashed because they're not been buying treasuries. Unsurprisingly so. It's a busted flush. There's a jaundiced eye on all Western debt, not just US debt, Japanese debt, UK debt. I meant to show you UK debt, but we'll do that when the Liz Trust discussion comes in. So I want to take you back now to these guys, because they're now saying, it looks like everyone's putting on a 1 trillion bet because they've had their reserve restrictions reduced, and they've been, as part and parcel of that, they've been coerced into buying some treasuries. And in spite of that, the market is still seeing the yields go up, which means there's more sellers than the banks are buying with their new additional overdraft that is available to them. So I want to see this circle be squared here by these guys.
Part of it, it could just be balance sheet de-risking too, where you just add more treasuries as just balance sheet ballast, for lack of a...
How is it de-risking if it's a failing asset right now? I mean, I know at the surface level, oh, treasuries, pristine collateral. It's quite clearly that's over. It's quite lost. 52%. Long-term treasuries, 20 years and more, lost 52% from its recent bull high. How is that? Who's perceiving that as de-risking? I mean, gold is de-risking. Yes. Precious metals. Jesus, I don't get that.
For a better term. That's the problem with all this economic or the banking statistics. We don't know exactly why. We can see what, and we can make those comparisons. We don't actually know why. Yeah. So it could be one of those two things, but either way, it doesn't add up to anything that's positive.
Right. So let's assume for a moment that, is that correct that I stated that they're...
He says either way, it doesn't add up to anything positive. Well, they may be positioning for a demand-destroying event when treasuries might get a little bit of a bump. Remember when treasuries got to that blow-off high, it was because the world got shut down in CV19. The difference is it's not just another cycle inside this range. People don't look at debt the same since CV19. That 40-year trend changed, guys. This is what so few people seem to be acknowledging, and I said it's going to be the most difficult call we've made that most people don't get. They think printer go brr. They think it's okay. It's like this bottomless pit that you can pull that stuff. This trend turned. This trend turned. The trend turned. This was a final capitulation. This is like looking at the dot-com blow-off in the NASDAQ. Don't forget, valuations are exactly the opposite of this. A dip, a blow-off, and then a smash down, you know, and then more lows. It's about looking at the dot-com and saying, no, this is going back to there shortly. It's not. The trend has turned. The trend has turned on this. And this is what people don't realize. And it comes through on this that it's just, oh, so even if they have a demand-destroying event, first, it looks like rates are going up. Second, they're not going to get the rate reductions. The ability to scare money if they crash the stock market into debt is going to be far less than ever before. That's what drove CV19 and gave them the right to issue 7 trillion in stimulus and all of this, because everybody was prepared to buy bonds at that time because the stock market, there was too much uncertainty. Bitcoin, of course, collapsed to below 4,000 from 14. All of these things took place.
They have the highest amount of treasuries they've had since Q1 of 2008. Was that correct?
That's what the report said. I mean, for the specific set of dealers that we're talking about. Yeah. Again, we're operating in the euro dollar context. We have to remember that there's
So they have the highest set because of they've had the reserve assets reduced, and they're being coerced to do this. And again, when we do come to the Liz Truss moment, I will show you how the banking cartel works with the central banker to capture the pension funds and other locked-in buyers, just like the petrodollar deal with the Saudis.
there's a whole lot of opacity and a lot of stuff that we don't see.
Right.
So what we're looking at is data that is a subset of the entire whole. We don't get to see the entire whole, nor do we really know how much the one relates to the other. So essentially what we're hoping is that when we have statistics like this, it's a reasonable proxy of what might be happening across the entire system. That's not always a good assumption. It might be that some parts of the system are just selling their treasuries to dealers and they're just buying them because that's what they do as dealers. But we think that because we can correlate these behaviors and these changes in behaviors to other market prices and market events, that
I think that's all just speculated a bunch. I want George's next question, because when does he deal with why the rate's going up if everybody's such a bull buying treasuries?
Options here, or two of the most likely options, following what you're saying, is you've got two options here, or two of the most likely options, which is either they're looking to expand their balance sheet and they don't see any other opportunity out there to take risk, and therefore they're going to take the least risk they possibly can by buying treasuries. That in and of itself isn't great.
By the way, neither of them mention in this discussion gold that I've been able to hear. I think I've listened to just about the whole clip. I don't want to say absolutely. And neither of them mention the carry trade, which I want to come back to, because you've got the Japan and the fact that the US actually is treated and has treated Japan as a wholesale low-cost funding system for speculating in the US casino. And in fact, other parts of the world has quite possibly done that too. It's not exclusively an American thing, but it is very strongly dominated money that has gone in, and America has needed a net inflow of that investment.
Because if the economy was booming, or even if they had an appetite for risk outside of the real economy, the financial economy, they would much prefer to take that because that would give them a higher spread on their liabilities and assets. So the simple fact that they're doing that tells you it might not be a crisis, but they're definitely risk off mode. And then, or it could be that they're super risk off in the sense that they see something coming that, who knows, might be similar to 2008, and they're loading up their balance sheet because they know that if that does happen, then they're going to make a lot more on those treasuries than just.
So that part, the fact that they're positioned to be buyers and keep the treasury market going until what I think is a demand destroying event for Q3, Q4, where they will be able to unload those treasuries into a panicked general investor in market. That's the only conclusion I can come from that. And the question I ask is, why are the rates still going up? Which point to the more they're buying, the value keeps going down.
Just the 4% interest rate that they're being paid. Is that a fair summary?
Yeah, and that's another option too. It's not necessarily a riskless bet, or we're buying treasuries because they're safe. It could be a directional bet too. They could be saying, okay, whether or not we're risk averse, it doesn't matter. What we see is that the economic circumstances, and financial circumstances too, are less than ideal, and therefore we're going to buy treasuries because as these fears that we have about the economy is a huge problem that we have too.
Do you think this would play into that repo spike we had the other day, just on the Fed's balance sheet? And then didn't we have, I don't know, maybe 2 weeks ago, where the 4-week bill was going.
So repos is about interbank lending, and that there's actually a loss of confidence between one American bank and another. That would lead to a repo spike, which just once again highlights the weakness and the loss of confidence and the skittishness of the banking system.
Quite a bit below reverse repo. Can you explain?
Yeah, there's a couple different things there. The 4-week treasury bill, the yield just kind of plummeted. Really, it just felt like the bottom fell out from it, which is unusual, obviously, because you should never see it go below the reverse repo, even in situations like there are some debt ceiling mechanics that go along into it, because money market funds are avoiding certain bills right now because the debt ceiling still isn't resolved, and there's not necessarily a hard limit, but there's a potential for a problem to develop in the middle of August. So we've seen the 3-month bill rate go up. We've seen the 4-week bill or the 8-week bill rate go up, which is money market funds avoiding those specific bills.
Okay, then as 4-week, right?
Yeah, so if they're not buying 8-week bills, they're buying 4-week bills as a replacement. But okay, you buy a 4-week bill as a replacement, but you're not going to just accept any return on the 4-week bill because you're still profit seeking. So if the 4-week bill goes below, the 4-week bill yield goes below alternatives, then money market funds are not just going to own 4-week bills just for the hell of it. They would shift into repo. At its worst, for them it would be repo. From the Fed's perspective, it's reverse repo.
Right.
But they would shift into something higher yielding. They wouldn't own the treasury bill. It's something well below even the reverse repo rate. So the fact that the 4-week bill was down as low as it was.
What you could do if you have cash is you could just give that cash to the Fed in their reverse repo facility, and you could get 4.25%, 4.25% on your money. But what's happening is we had this auction where there were all of these funds with money market funds, whatever, these financial institutions with cash. And instead of giving them to the Fed, giving that cash to the Fed risk-free, 4.25%, they
not
chose
risk-free.
to buy the 4-week bill at 4%. So they're taking 25 basis points less than they could by just simply parking that money at the Fed. So that in of itself is a head scratcher. You have to say, well, why on earth would anyone do that? That doesn't make any sense. And the answer could tie into what we're seeing with the broker dealers, that they want those 4-week bills or they want treasuries in general, because if the stuff hits the fan, then they can rehypothecate those treasuries. They can lend those out and make much more than that 25 basis point haircut that they're having to take by buying the bill to begin with.
Yeah, so if you're getting 4%, and it's a little bit higher than that when the investment yield. But anyway, you get 4% on the 4-week treasury bill, even though you can get 4.30 in repo. What you're betting is that if collateral becomes scarce enough, you can get a 40-50 basis point spread on lending out the.
So this is like minutia about these guys are taking this for collateral. They're even taking a slightly lower rate on the basis that they think in a future crisis, they might get 50 and go past 4.3 from 4 and get 4.5. You're talking about 0.2. I think they're missing the key point here. There's not enough understanding, or we see the world very differently. There's not the acceptance of a debt-based collapse in this discussion. And that's currency and loss of value. The minute you take a massive loss of value on your debt, you get a commiserate currency. They are twins. They've tied by an umbilical cord. So what we're actually seeing is fiat debasement when you have a major debt collapse. It goes part and parcel of it. It doesn't look like it occurs at the same time. It's either one foot, the other foot. But sometimes when after a while, and you start running, they can become almost simultaneous, which is what you're seeing now on the Japanese yen. America had a peak tariff tantrum, and the UK had with Liz Truss and Kwarteng. I want to move forward to another part of the video.
So then does this tie into the big repo spike that we saw on the Fed's balance sheet the other day, or was that just?
And so the long end of the yield curve under these conditions, higher import costs, which filter through to consumer prices. But either way, the Bank of Japan says we still have an inflation problem. Therefore, short-term interest rates are going to be increasingly uncertain. That's the term they always use. And so the long end of the yield curve under these conditions tends to be more volatile and move more. So if you're a large holder of long-term JGBs and the Bank of Japan is saying we don't know when we're going to stop raising rates, what are you going to do? Well, I'm going to sell my JGBs today and I'll buy them back when the Bank of Japan finally gets to where it is it's going to go. Or market circumstances force the Bank of Japan to come back to reality and say, okay, you're not going to go any higher. So what has happened at the long end of the JGB curve is all the pension funds and insurance companies in Japan have gotten out of the market. I think it was Mizuho that said, very publicly said,
But this is happening not just in Japan. This is happening on the long end in Europe, United Kingdom, and America. So what he's saying, which he finds so easy to say for Japan, actually applies for America, which he finds so hard to say.
the Bank of Japan made us do this. We cut our JGB exposure by 2/3. 2/3. One of the biggest holders of JGB said, we're going to sell our JGBs today. And then they said this, we're going to buy them back once the Bank of Japan is finally done with whatever it's going to do. So as I've been telling people more recently, the biggest source of uncertainty in the marketplace is central banks when they're supposed to be the opposite. So JGB yields, the Bank of Japan has essentially undercut all of its biggest buyers, and they're just sitting on the sidelines waiting for all this to finally work itself out.
How do you reconcile that with the long end of the curve always being about growth and inflation?
Because it is about growth and inflation with the, that's why they're going to buy them back at cheaper prices. It's growth and inflation expectations that are in treasury yields or JGB yields or, German.
And how do you not apply that same logic to the US, whose long end is also going higher, which is also being part of an inflation related trade? In other words, you're talking about, and they talk in this video about cuts and when the Fed will do cuts. And you've just acknowledged that the long end of the yield curve, yields running up, is essentially an inflation trade and indicator.
Bond yields, growth and inflation expectations are always there, but they're not always the primary consideration. That's why you have short run fluctuations in any market. Otherwise, market rates would just go to a single level and stay there. There's always back and forth. So right now, what the longer run holders of JGB, longer run JGB holders are saying is, we believe growth and inflation expectations are for a long end Japanese rates to be much lower. However, we recognize that in the short run, or maybe in the intermediate term, this degree of uncertainty that's being created by central bank policy means that whatever we believe of
he doesn't see a debt debasement. So he's seeing all these yields coming back down. And he talks in the exact same way. This is just range trade. This is just a bit of short-term uncertainty. The whole, and I'll need to find the point where he says this with regards to the American, but exactly what he's saying now about the Japanese, he's applying also to, in that sense, he's consistent to America.
long run fundamentals and growth and inflation, over the short run, the volatility makes it difficult to own these instruments.
It's all just volatility. This move up here is all just volatility. I want to show you something else. Let's just give our friends a rest there. We'll come back to them in a minute and do this. So if we go US 30-year, we drew this chart countless times. It's the yield curve inversion minus USO2 yield. We've got to delog that, pull this through. We drew this chart countless times before it broke. We said the yield curve reversion above zero was the beginning of the coming of that demand destroying event. And we said it's not always at the zero as you revert. It's at some point when it surges. And in our community, because we're HVF method focused, we've also drawn this particular structure here, which is about to take you through the target of a long-standing head and shoulder. So we got a left shoulder, we had a right shoulder here, and we got a M head over here with a projection through to a target there. And you've now got this little squeeze, just like on the US 10-year, by the way, which we're showing you is going to break up to the high side. We're saying the difference between the long end and the shorter end is about a surge higher as well, and make a target of a pattern that we drew the whole time through this period during 2023, 24, and up to when it's broken. We haven't shown this chart in a while because once it broke and it reverted, our point was proven that we are now in a space where there is a likelihood that you're about to make a reversion. And once you did that, it's a case of, okay, start the clock. You're going to have some form of demand destroying event that will occur. And it's normally when you're well on your way up and accelerating violently. We've formed a winding up structure here that is now going to surge through the target for this technical structure. And if we go and have a look, you will see that if you look at the bigger time frames here, you will see that the demand destroying event is on the point where you rise violently. So let's go back up to a monthly and have a look at all of this in a far more, let's go back to logs. No, logs, definitely not the chart for this. You can see that actually this 2007, you were still here and heading up. 2008 only came somewhere along the lines around here. Lehman crisis is here. It's when you're moving violently on the upside that this tends to occur. So you got the exact same here with the dot-com crash. It's when you're up here and the long end is running away. The long end has absolutely been, the control over the long end is gone by governments, and they're trying everything. They're holding on to the short end a little bit better, and the long end is just running. And that is invariably when the crisis then occurs. You can see that the difference was quite high here when Lehman's occurred. It was in and around 2.5%. It doesn't mean it'll always be that way, but it's similarly for 1991, 89, into the Asian crises and all these other events. So let's go back to our video.
Investors, what we have to realize is there's like 1,000 different cross currents that are impacting interest rates at all times. So you can't just focus on one thing, even if it's growth and inflation expectations, because although that may be the overriding factor over the long run, over the short term, you can have influences at the front of the curve by the Fed or the Bank of Japan. It definitely can influence things, but then you have to zoom out and say, okay, over the next 3 years, what's likely to be that overriding factor again? And that's going to be growth and inflation expectations, but it can be a wild ride in the interim because of all these other variables.
Yeah, just look at market interest rates here in the United States. Treasury rates since the bond rally began back in October 2023. We've had these big moves down, then pretty big moves up, and then big move down, and big move up, back and forth.
No, it's not. You see, he's making out that it's just a big range trade of ups and downs. Again, the chart puts the lie to that. If you go to the US 10-year, well, firstly, let's start with the long end, which is being lost. It's only going up. It's only going up in the modern recent times. Let's have a look at this. It's largely trading up. It's higher highs and higher lows. It's non-stop going to the high side. And 1, 2, 1, 2, 1, 2, continuation into a falling wedge, 1, 2, continuation pattern like that. What do you think's going to go? We've built our wealth trading. Continuation. And this was a blow-off collapse of a 40-year trend. Do you really think the unwind is going to be over from the absolute high, 22 in 5 years? Do you feel that the debt bubble has been released all out of the debt market? No, we've just started. This has just started. Where's the range trade? Because in a very short window, since the end of 23 to today, you've been inside the 5 on the what's it? It's actually 5.25 and the 4. My friend, that's just a continuation pattern. Of course, they get larger. This was a continuation pattern. That was a falling wedge continuation pattern. They get larger once they've made big moves and getting to key areas. This is structural pain that people are starting to fix. But have no illusion, technically this trades higher, and it is showing you that it's traded higher. And as I've already illustrated, its distance from the all-time high is incredibly short. So if you have a look at that, again, you're less than 3% from your post-COVID all-time high. And it's not. The buyers aren't coming in along the bottom. The buyers aren't coming in for debt along the bottom. It's not happening. New high, new high, new high. And the expectation should be, once again, a further high. So I don't agree that you're in a range trading environment. This is a trend, and this so far is a continuation pattern in formation, just of greater scale.
What makes it challenging, and you know this very well, George, is that every time rates go back up, everybody comes back with, oh, it's inflation again, it's debt fears, it's any number of, the sell America theme. So you do.
It's not just sell America. You see, this is patriotism and nationalism, where he's offended by the sell America, and there's emotional skin in the game. There's quite a lot of that around. It is sell America, but it's also going to be sell Japan. You're seeing it in Japan had historically incredibly low rates. They're still lower than America on the long end than compared to American rates. Only the UK is in as bad a state, I would say, as America by rates. But the German are going in that direction. Let's just highlight this, by the way, as well. So if we go GB 30-year United Kingdom, let's see, does that look like a range trade or a bull market? That's the Liz Truss incident. Of course, it's a blow off, so it's a short-term high, localized high. What happened? You traded higher. You formed a continuation pattern. You're broking out, and you're going higher. How is this range trading? This is a bleed up. This is a bleed up. And you can come and draw a rising wedge and tell me that's going to go down, and I'm going to tell you, on this occasion, I'm taking the other side of that trade to you. Because this is absence of buyers for debt, absence of buyers for debt. The mark keeps climbing, the money is exiting, and the rates are getting higher. And there's a lot of coercion to get people to buy debt. As you already admitted, the reserve, Bill Halter told you, the reserves were removed requirements on banks, providing that there was more money directed to the debt markets. And now the big thing that's eye-catching to them is, hey, certain banks are loading up on collateral, pristine collateral. They should be loading up on gold. They probably would love to load up on gold, but they're hoping that the government's going to give them a chance to get out of that pristine collateral in some demand-destroying event in quarter 3, 4. Where they'll be able to unload some of it when the stock market is made to crash, and a lot of scared money will be running in all directions, not just the debt market, far less so the debt market than any time before. So, that's the United Kingdom. Tell me about the 30-year in the United Kingdom. Is that a range trade too? No, it isn't. It's higher highs and higher lows. And that, my friends, is a bull market in yields, a bear market in debt instruments. So maybe they will see that if you show them the United Kingdom curve and they're less personally engaged on some sort of sell America or, don't, we're, greatest economy, dream, follow your dreams, come to America.
do have to, I mean, while you can't totally ignore these short run fluctuations and variations, you do have to step back and say, is this a short run variation, or is this something fundamentally different? And that's why you never focus on one thing or another. You look at the treasury yield curve or the JGB curve and find as much information as you can about, okay, is this a difference as far as fundamental perceptions and projections in the marketplace, or is this some other factor temporarily taking over the top spot for market?
Not some other factor temporarily taking over the top spot. It's not. It's a debt-based collapse, and that's where we differ. You know, he thinks this is temporary and that it's just, you know, a structural range, etc. And the charts don't support that view, in my opinion.
Participants.
Yeah. So what's interesting there is the one thing that you don't see really impact yields in the United States or Japan is supply.
I know.
But I think there's an argument that
How can you say that? Rates are going up and supply is going up. And you've got everyone and its dog that you're freeing capital up to try be a buyer, and they're failing to stop the rates from going up. How can you say that? Of course, supply is going to affect price in the long run, and it's already showing now.
who have seen supply impact yields in the UK or expectations for supply. How do you see the what do they call it when Liz Truss, the blow up they had there?
The gilt crisis.
The gilt crisis. Yeah. How do you see that? Is that a supply issue or is that something else?
I think what we're seeing here at the UK is that it's not just like 2022. It was not a supply issue. If it was a supply issue, why did it disappear? Because the supply situation didn't really change ever since then. You know, 2022, the UK government didn't all of a sudden discover.
Didn't disappear. So the news focus disappeared and you had a spike. Quite clearly, the debt market has continued to devalue. I just brought up the chart. The only thing was, this led to a disorderly devaluation. It was the pace. They then said, no, we'll step in and we'll fix that. That brought it back. What's ended up getting fixed? Nothing. It's continuing to lose. Just in a more acceptable, orderly manner. It is actually higher than it was at that crisis. There you go. Right now, you are worse off than you were at the Liz Truss crisis. It hasn't gone away. Again, it's a false dichotomy. He's not said an accurate statement.
Fiscal sanity. That never happened. What happened was we had a global circumstance in 2022, which led to volatility in long-term interest rates, but made holding UK gilts among the worst pieces of collateral. But it's not just the UK. It's not just U.S. Treasuries. You know, people are talking about the U.S. Treasury and debt supply now bothering the marketplace. Well, that's because long-term interest rates are rising in the U.S., in Japan, in UK, in Germany.
In short, what you want to say is the bull market for bonds ended in 2020, like I do, and that actually it's getting a far more critical and jaundiced eye across debt markets across the world, and that we are in a global synchronized debt-based collapse for which United Kingdom and America are right at the front of the queue. And as a hegemon, the failure of a hegemon leads to falling off a 26-rung ladder rather than a 3-rung ladder, meaning you should be warning your American citizens of a gross reduction in living standards, particularly for Americans, but generally for Westerners.
In all of these places, it's globally synchronized. And the long-term rates are rising, not because everybody is suddenly afraid of the US government, the German government, the UK government, the Japanese government suddenly becoming irresponsible. They've been irresponsible the entire time. That much hasn't changed. So that's not the explanation for why global long-end interest rates are rising.
They have been irresponsible. They created this problem, but it's now reached a critical point and the market is now focusing on it. That's the difference. Finally, they're saying you cannot continue. You cannot continue. The debt is here and people are not letting go of the issue because of the crushed economy, the need to maintain social services, welfare, Medicaid, and other in an environment on reducing revenue. And that is why you're getting tariff tantrums, trying to secure revenue, trying to reduce other countries from building a massive trade surplus with the United States, like the Eurozone and China, etc. So everything is being brought into focus because it's now recognized to be a debt-based collapse.
And global long-end interest rates are rising right now relative to where they were a couple of weeks ago. They're not rising overall.
They are rising overall. They are rising overall. Again, you mentioned the United Kingdom. They're rising overall. And your 10-year is going to do the same. It's setting up for a breakout.
They seem to be rising is because we have curve steepening going on. And curve steepening it gets applied to all of these different bond markets around the world that has nothing to do with these individual national priorities and national circumstances. So it's not necessarily a UK gilt crisis, but if your perception and your understanding of the UK market is the boundaries of the United Kingdom, you're looking for answers for why long-term UK...
That I agree. It's a global debt crisis, but why don't you say it? A global debt crisis with rising rates, particularly on the long end. Yes, there is a steepening. We've just shown an upside HVF. And when that steepening occurs, no mention of the yield curve reversion here either. You've had a yield curve reversion, which is a 100% indicator for a major economic crash, which is why we continue to say there will be a demand-destroying event, and we're deeply concerned about the August to November period for that whole event breaking.
Rates are rising, and you don't know that they're rising in other places around the world because the global curve is steepening. You think, well, this has to be the bond market is rejecting the UK government's budgets because the UK government budgets are absolutely insane. But then you have to step back and think, well, UK government budgets have been insane for many, many, many years. That actually isn't.
But it's now critical, and everybody's now focused on it. That's the difference. There's no more fat. Insiders are buying gold and dumping debt. That's why everyone's saying the time is coming. That's what's changed. It's the end of the bull market for debt. Again, you just have to say that. It's a bear market for debt. It's not a good hold anymore, where it previously was a good hold. It went up in value and it paid a yield. Now it goes down in value and it pays a substandard yield.
Changing. So why would the UK market suddenly discover the UK insanity and say, oh, today now it matters, where it didn't matter just a couple of weeks ago?
Okay, so, well, I think the argument there, Jeff, would be that they came out with that budget. And
there was a mini budget. So these guys didn't understand the trust drama.
And so you can mark a specific point in time.
And she went for a stimulus budget. So for this, we need to go to the Liz Truss story. And there's a whole YouTube here, and I'll put it in the notes. But essentially what happened that neither of these guys say was,
and that budget was
given a
released,
chance.
then yields skyrocket. So how was that not a catalyst? I think, wouldn't you say that that was a contributing factor, but that wasn't the main reason? That might have been the straw that broke the camel's back.
Well, see, again, I think that language is too strong. It's not the straw that broke the camel's back. What it did is remember, markets are not monolithic either. In every marketplace, even where rates are going down, you have people who believe that there's too much debt and they're willing to trade on it. And there's always speculators who are saying, I'm going to do what, whatever the market is in the short run. So you have all of these competing opinions going on in the marketplace. And in any short run period, one of those opinions can rise to the surface where, okay, there isn't exactly the same amount of urgency that would force those who are long bonds to buy more bonds. In fact, they actually like the fact that this narrative has developed that governments are going bankrupt, because what that means is there's going to be lots of short sellers out there who are selling bonds that are going to be forced to cover and do so desperately at some point.
They're not going to be forced to cover if they're right. They're going to make a shit ton of money, and you fail to see that this is an end of a debt-based market. He's saying it's great that there's people probably like me who are shorting bonds, who are short TLT, because we're all going to be forced to cover at some point. We're only forced to cover if the market turns. I haven't been forced to cover my loss, or the loss of the Japanese yen. I keep adding all the way along. And it's gaining in profits, and we have a target, and it keeps on keeping on. It's a continuation trend, and it's based off a debt devaluation in the long end of the Japanese debt market, and it's been seen as the funding currency that has to stay lower than the dollar at the moment, for otherwise there's a risk of the carry trade unwind, and it keeps on keeping on. No one's forced to cover unless the market moves in an adverse direction, which you're assuming it will, because you're saying it's all just trading in a range, when quite clearly the long end of the debt is losing value. It's continually, consistently, technically showing it's losing value in Britain, in the United States, and in Japan. 3 major economies, and it is the same way even in Germany, although they've got a continuation pattern that breaks and it's resting, and it's from at least a lower base than the rest of everybody else. And, George is part correct. It was the triggering point was the mini budget, which was going to be stimulus that was going to keep people, was going to hold back on a tax rate so that people spent more of their money and also did more investment and made it more a capitalistic aspiration society. And actually that would have lent digging deeper into the bond market to fund that for a while. And then they said too many bonds and they wanted her out. But in actual fact, if you watch the video on Truss, she threw out a long-standing Whitehall guy who is super leftist and social welfare spending type guy. They didn't like her. The Bank of England plotted with another. The Bank of England didn't raise rates at the same rate as America. So if you want to create a skittish UK bond market, as a global hedge fund manager, I can see America raise rates, devalue their debt, raise rates, devalue their debt. So I can buy a treasury for less than it cost, get a discount on a treasury, get a higher yield, while the UK didn't do as much. And the dollar it was gaining strength at that period. You can have a appreciating dollar, a higher yield, and buy the bond at a discount, or you can stay in gilts, have a pound that's going to underperform the dollar, get a lower yield, Which one are you going to do? And that part of that responsibility fell on the Bank of England by not matching the rate of climb that the Americans did on their own rates. They had done 0.5 over a period where America had done 0.75. So the Bank of England plus a stimulus budget saw more bonds coming to the market because of an initial choice to not overtax the taxpayer and stimulate the economy. And as a result of that combination of the mini budget and that the UK gilt market was already weak because it was paying a lower yield to America. And that led to the crisis, which we predicted at the time it occurred would happen in America, and it was met in peak tariff moments when the Treasury spiked and the dollar crashed. And that's when everyone said it was an attack by Japan, China, Davos man, and everything else, only to find out that it was actually Americans selling American-based assets and moving it into the cheap European stock market, as we showed you right here. So there's so much misinformation of cause and effect that's going on around here.
The future. So I'm going to sit out the market, let rates rise and prices fall, and then I'll buy again when the prices hit the whatever level I really think of. So you have all these competing interests in the marketplace, which is why you see these short run fluctuations. So the idea that UK rates are skyrocketing, or that they're soaring, or that something substantial or significant or fundamental has changed here, I don't find that argument compelling. I think what's happening is in these.
It is compelling. It's not like overnight soaring, but that is a very, very abrupt loss in value. If you look at the rates at the post Bank of England saved the day in England, in the United Kingdom, you are up 81% on your yield. You were 3%, you're now 5.5%. And inside what duration did that happen? 22 November, which was the peak of the crisis, to July 25. So in 2.5 years, you've seen an 81% increase in cost of borrowing. So what actually would be, a concerning move in rates? Please explain if that's not concerning. So as usual, you're getting a lot of hyper-normalization of the fact that we're in a debt-based collapse here. Let's just hear. He just inferred he doesn't find that particularly concerning.
So the idea that UK rates are skyrocketing, or that they're soaring, or that something substantial or significant or fundamental has changed here, I don't find that argument compelling. I think
You don't find the argument compelling. I mean, you just have to look at it. It's not the only UK debt instrument. It might not be as chronic on the 10-year. We can put up the 20-year, which sits halfway in between the 10-year and the 30-year. Let's measure that. So we were at over 80%. Here we go. From the bottom of the crisis to where we are today, which is not yet spiked, 69.8%, 70%. That's not compelling? Wow. Okay. Whatever you say, go.
What's happening is in the short run period that we find ourselves in right this moment, rates tend to be rising and people are filling in their own narratives about why that is. And in the marketplace, because there isn't something.
There's only one narrative when rates rise, is that people don't want the assets. They're not buying it. It has to offer a higher yield. Its price goes down, and that means the yield that it now pays at a cheaper price goes up. That's bond markets for you. How do you argue? There's only one narrative. If the price keeps getting cut and the return keeps increasing, it means it's not a very good asset class for capital appreciation. They're continuing to try price discover a level of yield for which they cease to lose value. And until they do that, they're going to keep losing value. Why? Because there's an inordinate number, a supply of new debt coming in an environment where the market no longer sees it in a bull market for capital gains. The 40-year bull market is dead. Neither of them have said that. And this is something we said in 2020. And neither of them can even say that. They just think, oh, it's just had a pullback. It's just going to range churn from here.
Something immediate and urgent today that compels the other side of the marketplace, the bulls in the marketplace, to buy. They're just sitting there waiting for prices to be cheapened, like the pension funds and insurance companies in Japan, waiting for the right moment to start buying all over again.
So in his worldview, there's a wall of money sitting on the sidelines, all waiting to whale into treasuries, British debt, and Japanese debt. And the market is telling you, the rate that we are paying has gone up 80% on a 30-year UK bond, 70% on a 20-year. And still that wall of money isn't coming. but gold's going up. Have you heard gold being mentioned in any of this? No.
Why don't we typically see those bumps with headlines in the United States? So as an example, the big beautiful bill comes out, that gets passed. So now all of a sudden we know that that's going to increase.
And what exactly does the big beautiful bill mean? It means way more debt in supply. So I'm guessing that money on the sidelines that you think is doing nothing, sitting on the sidelines in what asset, I don't know, because it's not debt, is all going to come wailing in. If it's certainly not going to wail in on the big beautiful bill, which is more spending, is it? So it's going to continue sitting on the sidelines. Maybe it's not on the sidelines. Maybe it's buying gold.
The deficits by X amount, that's going to increase the debt by X amount. Why don't we see a guilt-like moment where even if it's just a knee-jerk reaction for 2 or 3 days, that yields spike and then come right back down? Like I can't remember a time when I've seen that happen in the treasury market. Now, I have seen it happen in the treasury market where Trump comes out and says, okay, no more tariffs, as an example. And then you might get a bump in yields because the market is expecting that growth is going to be higher. Or we get a...
So George is trying to say, which I again wholly disagree with, that the passing of a massive bill, which is going to see the fact that he was never a man about good sound money and huge spending, huge ceiling limit, all the same boondoggles for political corruption causes going into the debt market, is actually having no effect on the debt market. Yet, when we show you the 10-year, or for that matter, let's go to the longer end, which is the bit that is being lost the most first with the steepening of a curve, you're barely 2 or 3% off your all-time high post the COVID. How is this the acceptance that you're going to be going higher and you're within just 2 or 3%, not a sign that the market is not accepting this very well and is putting a lower price and wants a higher yield? Look at what's happened today. The daily curve, as this bill is passed, that's what's happening. Again, I don't see it the way they see it. Why aren't your rates coming down if everyone's so happy with the big beautiful bill? Why aren't your rates coming down? It's not what's being evidenced.
Not a blowout, but we get a better than expected non-farm payroll. And then you see yields go up slightly because it's expecting that the Fed's going to stay higher for longer, or growth in inflation is going to be better than we otherwise thought. So I see those types of headlines moving treasury yields, but I never, ever, ever see the supply side, even like a knee-jerk reaction like we saw in the gilt market. Why do you think there's that substantial difference between the gilt market and the treasury market?
Well, the treasury market is far more internationalized to begin with. It's covered. Its primary purpose.
So I want to show you, they're talking about the treasuries as if America is different. Well, we saw with peak tariffs that it wasn't different. We saw that the treasury rate spiked and it's never recovered from. If it was just a once-off, why didn't it come back? Here's the spike. Here's the April spike, peak tariff tantrum. By the way, the dollar went down during that period. Here's the spike, and that's where you are. You're basically at the top of the spike today. Why didn't you take it back? You were down here. If the market wasn't affected by it, why hasn't it returned all the way back to where it was before? Oh, he took the tariffs back. It's all back to love and cuddles again. Why aren't you back where you started? You're not. You're on the high end. It's a debt-based collapse. The market has changed.
This is way beyond just the United States, whereas the UK is more of a niche.
Okay, let's deal with the UK video I wanted to show you. Actually, that's what I want to show you. So here's how the banking cartel of the Central Bank of Britain, Bank of England, the pension funds, the dumb money, the managers of dumb money that are actually coerced into investing into government gilts, which is just bonds in UK, and how they weren't getting a return, and the solution the Bank of England came up with that made the system even more sensitive, even more leveraged, and then failed to match the American rate increases that led to a prime minister and a chancellor being thrown under the bus. Not that I like either of them, not that I don't trust politics on any side, but the Bank of England is the blob. This is what they're referring to, the dark state for the UK. Let's watch this.
Pronouncements coming from the Chancellor and the Prime Minister essentially destroyed confidence in the financial management of the United Kingdom. And that's where all the responsibility lies.
Could simply proposing a
That was what was being put forward by the Bank of England.
budget do all this? Part of the answer lies in an exotic financial instrument called LDIs, liability-driven investments. UK pension funds had heavily invested in LDIs. Why? Pension fund managers were encouraged by the Bank of England and regulators, the so-called blob, to invest in government bonds, called gilts.
So that's the Bank of England coercing private money, put in a pension for your old age to buy government debt, a terrible instrument, which gives them the opportunity to overspend, which is tax on you. All economic overspending to income is a tax on you through inflation and debasement.
But due to low interest rates, the gilts were not generating enough income to pay out full pension benefits. So the Bank of England and the regulators encouraged the pension fund managers to invest in LDI funds. The LDI fund manager, using the gilts as collateral, buys more gilts. He does this.
So listen, you buy with your 100 billion from your pension fund gilts. You then pledge that as collateral to get leverage to buy more.
Several times, further leveraging his investment. It all works fine, unless interest rates rise.
So basically, you're not getting enough yield on your Bank of England instruments. You've gone through a 40-year bull market where you once were paying double digits, then you have 9s, 8s, 7s, 6s, 5s. You're being coerced into buying this instrument that's now only paying 1 or 2% yield at the peak bonds before COVID or during COVID. And you're saying, well, that interest, that 1 or 2% that I'm earning isn't enough to pay my pensions. And they say, don't worry, we'll fix this for you. You need 5% yield? What we'll do is we'll take the 100 billion and we'll lend you, let's say, 300 or 400 more billion to buy the same asset again. So now you get 5 times the yield, 5 times that 1%, which is like you are getting 5%. Only you have a much bigger position. You actually have a liability. So instead of buying a better asset that pays a better return, that isn't at the end of a 40-year bull market, you get more leveraged at the end of the bull market to get a higher yield to meet your obligations on an asset that now you're so big, you're automatically going to have the whole system is super sensitive to rates because you're actually holding 5 times the amount of the asset than you should be. And if the rates start to go up, your 100 billion is the first 100 billion to be lost. So if you have 500 billion in the assets and you use the first 100 as collateral and you kept pledging them as collateral, if that loses 20%, if that 500 billion loses 20%, you've lost 100% of your collateral. Can you understand that this is just Ponzi-onomics? This is a sophisticated way of saying the Bank of England took their own asset as collateral to get people to buy a whole bunch more of that asset. I mean, now, here's the thing you need to think about. If the UK is doing something like this, what did America do when we were hitting the low assets? What did Bank of Japan do? If this is what the curtain pullback reveals, that the Bank of England is part and parcel of a Ponzi scheme that boosted yields for pension funds by taking an initial purchase as collateral, providing they purchased even more of it, till they reached the yield they needed to match their pensioners, they are actually inbuilding a terminator switch to their pension fund, that the minute the bond market turns, those assets will be destroyed, and pension fund managers went along with it on your assets. So who is the eventual person killed? The citizen, who will lose their pension, that will go bankrupt. Who enabled it? The Bank of England and the pension fund manager, the dope, the patsy at the poker table. And these exotic, highly leveraged instruments that actually, instead of saying buy a better yielding instrument, say buy a whole bunch more of the instrument until the yield gives you what you want, and we'll collateralize your first payment, and when you buy more, we'll let you stake that and collateralize that as well, so that you can buy more and more and more until you actually have a ridiculous holding in an asset whose value can actually also collapse. And as of course we get to the turning of the bond market, this is why I've said this is a controlled demolition of intent. The end of the debt market is the end of the financial system as we know it. And if you think it's only the UK that has pulled that trick, you're sitting in a globally synchronized, Western particularly, debt-based collapse where all the rates are doing much the same. Don't tell me it's only the Bank of England that's pulled this Ponzi on pension funds. You've had the second largest pension fund in the United States, the Californian Teachers Fund, not be able to make a pension payment. Instead of being allowed to sell, there is no liquidity in the debt market to the levels that you think. They said, don't sell. We'll loan you the money against it as collateral. How is that not a similar based system to what you've just had described here in a Ponzi-nomics based system of borrow, pledge, borrow, and pledge? By the way, that's what Japan did during their boom in the 80s. Buy property, pledge the property as collateral. It's gone up 10 times, borrow 9x, buy 9 times the portfolio size you already had, pledge it as collateral, etc., etc., etc. This doesn't end well when the trend for the asset changes. The trend for the asset has changed. Neither George and Jeffrey Snider have acknowledged that. They think it's range trading. The rates are all going to come down. They're all going to get cut. This is a Ponzi scheme. It's going to collapse. Bond is a failing asset class of instrument of investment, and you are going to see the repercussions. And with it, it brings the related fiats down with it in buying power. And as the money exits the different debt-based Ponzi schemes in all the different nations, because it is the asset category across all nations, although, as I say, the US and the UK are fighting to be first through the bankruptcy courts, you will see the related fiat's buying power collapse as well. But first, you may have a disinflationary event of a demand-destroying event that will go into the Q3, Q4 era of here. And that's when everything that isn't nailed down might get sold as money is being destroyed. And actually, there will be a shortage of fiat. Why you should hold cash for that moment. It's not an investment. It will be devalued. But for a few months, while there's absolute crisis and contagion, or maybe 6 months, who knows, you'll be bled dry, and banks could be closed. Counterparty risk, all forms of grid down, ATM down could take place. Okay, thanks for watching, guys. This is where we're at. Tell me who's right. Is it just range trading? Is this a debt-based collapse? Are the rates all going to turn around and come back down like Jeffrey Snider says? Is it really a bunch of nothing, this UK debt movement upwards? 80% increase in debt. Is it really not meaningful? Or is it meaningful in terms of the yields? And don't forget, the call on the US 10-year is that you're going higher. 6.15 is coming in our view as per HVF method technical analysis, which says you are about to break out of a continuation pattern. And by the way, the long end is going to be worse. Remember the yield curve that we showed you with the difference between the 30-year and the 2-year, it's going to get worse, and you will find yourself in a situation where the long end is even worse than the 10-year, that the super long, the 30 years, etc. So interest rate spikes all around, currency contagion. This could be very, very interesting time. And as I say, be warned for Q3, Q4. I have a nervy feeling about the state of the debt markets running into that. Don't forget, if you want to trade this, and by the way, what a trade. It's still the gift that keeps on giving. Swiss franc JPY will be long until 190 on that. Look at that move. I mean, look at that move. Beautiful, beautiful. There was the fractal we gave you. Here's the far larger setup over there. This baby is just running, and you're going to have trends that run and run and run. And it's a semi-serious fiat against a funding fiat that has to stay for now weaker than the dollar. If that turns, which we think it can in the longer term, you could have a very nasty unwind, and the yen could suddenly revert to being very, very strong if it devalues too much too far and the carry trade starts to get unwound. So watch out for that as well. That could be part of the crisis. I didn't hear the carry trade get mentioned. I didn't hear the gold get mentioned here. I didn't get the loss of reserve asset status for debt market get mentioned. It's all just chop and range changing, and I can't agree with that. Okay, till next time, talk with you later. Click a link below to find out more about what we'll be doing and how we'll be maximizing this time. Bye. Bye for now.
Tired of profit wipeouts and blown accounts from following trade signal groups? Looking for a better way to trade? Why not be part of a principled, structured, and technically based community set inside a unique trading methodology? Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser or app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time, and with focused effort, you'll begin to look at charts, price action, and markets in a whole new light. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.